So I'm going to talk about two papers that I've done with some different co-authors. So one's with one set of co-authors and others with another set. And I wanted to stop, since we've talked about the news data kind of all day. Why are we even talking about news? So in the kind of past, we've talked about news because we care about information that is released. Well, news data that we're talking about, so news data that we're talking about isn't news, right? It's a manifestation of the news. And so why do we care about these manifestations of the news? A couple of reasons. These have been sort of talked about a lot today. So it can be a potential source of information that is not provided through other sources. So earlier we heard about it could be a manifestation of soft information. It could also be that this information is more timely than other sources where you might get the information. Then the two that I'm going to talk about today is, even if news doesn't provide incremental information on its own, it can interact with other sources of information, other information providers, and it can also influence the information that is provided through other sources. And then also, the part was mentioned earlier just briefly, is that news coverage can make companies and news events more visible, even if it doesn't provide information about a particular new source of understanding about the company or an event. So what do? So these two papers, the first one asks how news visibility influences other information sources. And in particular, we're looking at credit rating agencies. And I'll show you kind of what we think visibility does to the ratings that credit rating agencies provide. And then the second paper is looking how does news coverage vary across sources. So I'll show you a bunch of different how sources, the coverage that sources choose to make differs depending on whether it's a kind of common newswire type of a source or a news aggregator or local news source, something along those lines, and how that differs across whether this is a good news or a bad news story. And then also how visibility affects how investors react to information. And I'm going to do that in a few different ways, and I'm also going to look at different sources. And there are different hypotheses about how investors react, and we're going to try and test some of those hypotheses that I'll discuss in just a minute. So the first paper, what do I find, is that credit ratings are more timely and more accurate if they're covered by, or they receive a lot of news coverage. So maybe this isn't a terrible surprise, but what it does suggest is that by recognizing firms that receive a lot of coverage, it's going to influence the precision of the other sources of information. And so if you have some sort of trading strategy that's relying on an information source, the precision of that source and the precision of the information in the market will vary depending on how much news coverage they receive. However, there's a side effect in that credit ratings are more volatile for highly covered firms. Then in the second paper, this may be sort of interesting. We haven't talked about this much today. Well, it may be sort of. To me, it's all interesting. That's why I'm doing it. Hopefully it's sort of interesting to you. So bad news receives more coverage than good news in newswires, the national press, and local news outlets. But the reverse is true for other outlets. So good news receives more coverage than bad news from news aggregators and internet-based type news sources. And the gap between good and bad news, so good news receiving more coverage than bad news and bad news receiving more coverage than good news, depends on what the story is about. So if it's about firm fundamentals, that kind of gap doesn't exist. And if it's about big companies, the gap is increased. So in the case of newswires, for example, I know we have somebody that has a vested interest in newswires here. So bad news receives more coverage than good news in the newswires. Well, for big companies, that's even more so the case. So in newswires, bad coverage gets more, or bad news gets more coverage than good news for newswires. And the reverse is true. So for news aggregators, so like Yahoo Finance, for example, they cover big companies get more good news than bad news. And for fundamental-based news like earnings, for example, there's very little imbalance between good and bad news. And then finally, I look at returns, and what I would like to try and find out is, so we have these stories about if there's lots of news coverage, journalists, whether professional or, I guess I can't call them unprofessional, some other word. So some journalists may want to sensationalize news, and others may want to just provide information. Well, we have these stories about sensationalizing, and one of the stories behind that is that kind of less sophisticated investors are going to pay too much attention to that news, and they're going to overreact. That's one story of what news can do. Another story is that it's in following Merton, his paper in 1987, he would say news just makes companies more visible, so then it's going to create kind of upward pressure on stock prices overall. And then the last one that I'm not going to try and talk about too much is that news just provides information. Well, what I end up finding is support for the Merton idea that news coverage just inflates prices in general. So,
this is using RavenPack data or different?
This is using RavenPack data.
Okay.
So I guess that the question is, why RavenPack data? Well,
you have it.
I have it, so that's the nicest thing. A second is, so you'll see that I'm going to split on news sources, which is something that RavenPack is providing, which is quite nice. And then they provide some nice sentiment measures, which I don't rely on that too much, but a little bit in here. So, so credit ratings. I'll try and get to the just main story here. So our idea in this paper was that when we see news coverage, it's not an isolated thing. So I'm trying to come up with an example. Let's say, we were just doing foreign exchange stuff. So you could have some trading strategy that you use some signal, and you say, when that signal comes out, there's going to be mispricing, or mispricing is going to get corrected, or risk is going to change, right? Whatever your kind of objective is on that information source, then our view was that the information from one source will actually influence information from another source. So if you decide to trade anytime credit ratings change, well, that is going to depend, the nature of the credit ratings will depend on information from other sources. And for the rating agencies, our kind of intuition was pretty simple in that if there's a lot of visibility for the rating agencies in the companies that they cover, they're going to be more timely and more accurate in their assessments of the credit risk of the company. And that's what we find. So I won't spend too much time on that. But we do a whole bunch of analysis. If you're interested, I think we posted the paper on SSRN if you want to read it. But if you don't, here's what we find. We find there are downgrades, there are upgrades. They're all more timely when you, I'll tell you what it is since you won't be able to see it in the back anyway. So if you, more news coverage means rating agencies respond to bad news more quickly. They respond to good news more quickly. They also, their ratings anticipate defaults more. So that's what this one is saying, going into a default, did they rate a company kind of that with a rating that would reflect that they're going to go into default? And then these other two are, do they falsely identify a rating? Do they cry wolf and say, we think there's going to be a default? Or do they say, do they miss the default? Either one of those measures, more news coverage means they're more accurate. They don't miss things when they shouldn't, and they avoid falsely forecasting when they should avoid it. I'm getting caught up in some ridiculous words here. So, okay, so now let's get back to the second paper now. So what I wanted to do was look and see, does visibility, so the first paper was trying to look at how does visibility matter? Does it influence information from other sources? Now I'm going to look at what determines visibility. So across news sources and across kind of good or bad news, can we identify that there's systematic patterns across the types of news that receives more coverage? And then I'm going to try and test these different hypotheses. So the first one, I kind of talked about these briefly. The first one is just that news provides information. So the business press is actually news to the market. The second one is that this can incorporate two things. First, that news attracts investors' attention. They react more fully to that information, or they overreact to that information. And then the final one is that news just makes companies more visible. They're coming for me. So. Oh, that's what I just said. So let me give you some interesting descriptives here. So if you split the news on RavenPack ESS, you see that good news by far outnumbers bad news. So, and you can split this a bunch of different ways. It almost always turns out that there are just a lot of good news stories. I have beliefs about why that happens, but I don't really know. So.
What was your time period?
This is 2007 to 2012, and then I also did the 2000 to 2012, and it kind of all looks similar, yeah. Then this is the number of stories that per event. So there's an event identified in RavenPack, and how many stories actually follow up on that or cover that. So you'll see most of the events are slightly above 1. On average. So that means that you identify an event, and for the most part, you're going to get 1 or 2 stories for that individual event. And what I was interested in is the balance between good and bad news. So the left-hand side of each of these is bad news. The right-hand side is good news. And you'll notice for the news wires, the left-hand side bar is higher than the right-hand side bar, showing that the per event stories are greater for bad news than for good news for news wires. And then, we kind of move over here. It's the same thing. This is the national press. So this is like CNN or CNBC, MSNBC or CNBC, things like that. Then we get to another one I find interesting. Let's see. So web-based sources and local. So local-based news looks like the news wires. The aggregators, this would be like Yahoo Finance. They're slightly tilted towards positive news. And the web-based sources are more tilted toward positive news. We think that this is because these different news sources have different... Oh, yeah, go ahead.
Yeah, I was just struck by the balance between the good news and bad news in this chart and the previous chart. And it seems like I would thought there are 2 different data sources.
So what this is, so the difference here is this is per event how many stories show up. The first one is the number of events. So there are more positive news events, and that is just kind of a striking thing, right? But if you want to look at conditional on there being an event, once you see an event, how many stories show up? That's what this one is. So if you add all of these up, you end up with the same positive thing again. So we stumbled on this, and we think it's interesting. So if you actually look at the longer data set, this picture shows up much more strongly. So part of it is because it's dominated by news wires. The other part is we think just because of the things changed a little bit in the past. So
you were going to say your theory. What's your explanation for the differences in the domains?
Oh, so
the readerships? Or?
Yeah, so we think who's reading these, right? So the incentives that these providers have, we think determines what types of stories they cover. So for example, if you think about, well, I don't think there's time to talk about all of, we have a couple different theories. But one, you might think that the news wires, for example, their goal is to never miss a bad news thing, right? So they're going to try and make sure that that gets covered and they never kind of miss a triggering event for something that goes wrong. And for whatever, that, you know, the investors that are paying for that care about it.
No false positives.
Yeah, no false positives. So the other one that seems a little easier to think about is the web. So if you look across a bunch of websites like is in this data, people that are putting down these stories, a lot of them are firm related or firm initiated, or they are industry publications or things that kind of are favorable to companies, right? So this I think sort of reflects more like what companies want to get out there, and maybe Newswires is pushing the other direction to say all firms want is good news. We're going to act as kind of a gateway to not allow them to just get all the good news out, right? So I think something like that is going on. So then, you know, the question is does this hold up? If you put in a bunch of tests and control variables and things, it just is that way. Again, you don't need to see it in the back. All it does, the same thing I just showed, is that overall there's sort of a negative bias towards covering more of the bad news stories than of the good news stories. So what that means is for every good news story, so I showed that there are more good news stories, they just don't receive as much follow-up coverage. The bad news stories receive more follow-up coverage. And that tends to be the case overall for newswires, for the national press, and then for the aggregators and for web-based sources, that it flips the other direction. And then down here, again, you don't have to see it, but interacted with fundamental type events, that goes away. So any of that bias towards good or bad news for fundamental type events, it sort of disappears. So then what we did so this is at the end. So the question that you might want to know, and that frankly some referees want to know, is what happens with returns, right? And to test some of these hypotheses, then we would say, so this is the one-day return, and then the next slide is going to be the one-month return. The overreaction, the idea that news captures investors' attention and they overreact, would then suggest that there's a bigger reaction initially that gets reversed in the future. If they're just grabbing investors' attention and they pay attention to the actual news story, then it would suggest that there's a bigger and more complete story initially and nothing afterwards. And then finally, the Merton idea that there's just more attention being paid to the firm overall would suggest then that there's positive reaction initially and it keeps elevating. There's continued price pressure in the future. There's no evidence of reversal. So that what we end up finding is primarily that it looks like news is creating upward pressure. So you'll see if you split on RavenPack the positive and negative sentiment on the day of the announcement, this is sort of what we've been saying. Positive news has a positive return, negative news has a negative return, and these are relative to their industry is what I did this time. And if you interact with all news stories, you get this idea or this reaction that good news stories have a more positive reaction the more news coverage there is, and nothing on bad news. Well, if you look at individual news sources, so I can't even read this. So, okay, here we go. So newswires, you'll see that both positive and negative news has a more positive reaction the more news you have, which means when there's bad news and there's a lot of coverage from the newswires, it's creating upward price pressure, kind of nullifying the bad news. And the only kind of one that goes consistent with the sensationalism story is national news sources, so CNBC, MSNBC, NBC. I'm stuck on the BC ones. There's a bigger negative reaction. So something gets covered on one of the major sources that everyone sees. That was mentioned earlier today. My wife and her parents and my parents, right? They're never going to look and see, look what just came across the news wire. Right? They see, whoa, what happened on the news tonight? And did you know about this? And then I say, well, yes, of course. You know, we know about these things beforehand. Only after the fact. But this sort of, you know, lines up with that story, is that if it's going to get on one of these major sources, retail investors would be my story. They react strongly to this. Interestingly, if we believe that it's primarily kind of institutional type investors that are reading the news wires, they nullify, their buying effects nullify the negative reaction. So then finally, the same pattern sort of shows up in month-ahead returns also. So you notice, we've seen this before in other studies doing this type of research, that after a while, so if you look at long-run returns, there's very little reaction to positive news, kind of in a long-term sense. But there's continued reaction to negative news. So this is the idea that bad news travels slowly. But if you have lots of coverage by, what did I do this? By news wires or news aggregators, which is down here somewhere, there's pressure nullifying the bad news effect. So even though overall bad news predicts longer-term negative returns, it doesn't happen if there's a lot of coverage, particularly from news wires and, in this case, news aggregators. So the takeaway, I guess, my story would be, if you're going to trade on this stuff, you don't want to just split on sentiment. Right? You want to think about the amount of coverage also. And so this was shown earlier. I think the story is lots of news coverage for good news is a trading signal. Little coverage for bad news is a trading signal. And you know, that's the type of thing you're going to want to think about. Have I tried to do that trading strategy here? No. And I won't until the referee makes me do it. So, all right. Well, thank you, and I guess we're ready for questions.
Okay. Thank you, Jeremiah. That's interesting. I actually have one as well, but I'll wait for any questions from the... Yes, please.
Thank you for your talk. My primary interest is in reaction to news in commodity markets. And what we see there is across all parameters. Bad news is much more significant than good news, no matter how you look at it, volume, source, anything, how long it lasts. So it's just bad news is, you know, has big and persistent effect, and positive, well, nobody even looks at it, almost looks at it like. And why do you think it is? Does it mean that stock traders are sort of cheerful bunnies and commodity traders are sort of sad suckers that just sort of, you know, doom and gloom and pessimist? Or do you think it's the composition of the kind of investors? So why such a symmetry? Never I saw that the good news is, you know, more price driving.
Yeah, yeah. No, good question. Now, just be aware you're asking an academic for an opinion. That's dangerous. So, okay. So that's why you're asking me. So, so I don't know if I should answer or not then, but I'll tell you what I think might happen, but I have no idea. So the interesting thing we find here is that when you condition on the coverage that a news story gets, this idea that, so here we get, if you were to just do a month-ahead return on sentiment, positive and negative sentiment, the conclusion would be only negative sentiment has a return predictive power, right? Well, I think when you condition on the visibility that a firm has, I don't know how that would relate to commodities, but something about visibility seems to change our understanding of how news predicts returns. So I would guess there's, if I were to directly interpret infer from my study something about the commodities markets, I would say there's something about visibility that is that we think makes it that bad news is only bad news gets reacted to, but visibility is actually the missing link that we haven't controlled for. That's what I think. I don't know.
Well, yeah, it's like it's more concentrated, right?
Yeah.
Maybe from 500 stocks, you've only got 15 all of a sudden.
Yeah.
So there's a lot more visibility, which might intensify that.
Yeah.
And by the way, you made the right guess. It's the composition of players. Me having traded commodities for 28 years, and commodities only became institutional just recently. But if you take long-term data, the participation is very wide and very retail. And we always had a saying that commodities go up on a staircase, come down in an elevator. So when you get overcrowding in one commodity, then bad news knocks everybody out right away. So you get the right guess. It's the composition of the players.
And use of margin.
Yeah.
If you had that same issue with commodities, though, what about like an Exxon Valdez or BP Gulf spill? I mean, that gets national news. Here it got national news, and that's going to raise visibility, which apparently if you raise visibility, then you should get.
Well, that on the prior slide I showed that if high visibility in national news sources, which is sort of my proxy for retail investors, that does have a much stronger negative reaction. So source and kind of content sort of matter. So yeah.
Can I ask actually one question and one observation? One question is, when you count newswire stories, are you counting when the newswire updates a story as being the same story as being another story? Because it's about, on Reuters, it's about, when I look at it, it's about maybe a quarter of the stories later have an update. Sure.
Yes, that's right. So
Separate.
yeah, so RavenPack may want to respond to that, but what they do is they track kind of initial story and then anything that looks like that moving on, right? And so depending on how you filter that out, you can pick up more or less of that, but how I have it here, it counts those follow-ups.
The other one is just more of an observation. In at least 20 years ago, trading OTC markets, in my case FX, was always a notion that bad news is unexpected and good news is expected. It's usually in regulated markets that, like equities, or where there's a government announcement that good news is announced with the same suddenness. In OTC markets, conventional wisdom was always that people leak good information. Yep. The Exxon Valdez was a catastrophe. It's bad news that's unexpected, so
Yep.
demands more attention.
Yeah, so I totally agree with you, and I would love to be able to do that better. My kind of rough proxy here is I would expect web-based type sources to be expected type of news, at least if it's my wife blogging about it, right? That's not fair to RavenPack. They're not tracking my wife's blog, so not yet anyways. So. But I think that notion of that there's timely information and less timely information, and it may differ across good and bad news, I would love to figure that out some more. So.
Anyone else for a question or a comment? You're not allowed on that.
Sorry, I just have to ask, because I think it's really interesting what you've done here. So you mentioned about good and bad news, and I remember we did a study a few years back where we looked at that exact problem to figure out why is there more good news than bad news, and we ended up determining that we should never underestimate the power of a PR agency. And it turns out that big companies, especially large and mid-cap companies, have great power to distribute press releases. And a press release typically includes good news. I mean, even if you're going bankrupt, you can call it a new beginning.
Yep.
So it actually turns out that it is possible to manipulate the market in that sense, and that you can constantly supply it with good news. So
Yep.
that could perhaps be one of the explanations. But
Yep.
my question specifically relates to how do you see retail investors acting or behaving, and whether are they conscious of this sort of asymmetry between what is done by professionals that have access to news wires that perhaps know a little bit more about news dissemination that they do. Do you think that that has a real impact, or is are market forces correcting for that?
Yeah, great. I would love to know the answer to that question. From what I can tell from my evidence from these tests, institutional traders could be doing similar things that kind of retail investors are doing, but how they're doing it is slightly different. So I think mine would say, if you took it at face value, institutional investors are buying too much on bad news, and then maybe those that are the retail investors are, it's counteracted when retail investors sell a bunch on bad news. So I don't know. I hope that would be great to figure out. I just don't know yet. So.
Any other questions, comments? I think you did it, Jeremiah. Thank you very much.
All right.
That was very